Dear friends of Grey Rhino, I'm very happy to be seeing y'all once again.
In fact, I've been talking about it since end of last year. Yeah, because I keep thinking, US, I think, since it discovered the ability to print money and without causing much chaos, it has been getting deeper and deeper into this game, right? So it seems like even something as serious as COVID, which supposedly will cause something as bad as a Great Depression, only lasted 2 months because the Fed decided to send their printing machine on overdrive and it solved the problem. So the question is, would there be anything that can't be solved by money printing? And one of the key things is really inflation. Okay, it's not inflation that we are worried about, right? It's inflation that causes a tightening of monetary policy. Because as everybody know, especially growth investor, I think we've definitely realized that the earnings multiples of this growth company has way exceeded the increase in earnings. Now, to put it simply, these companies have gotten more expensive. Okay, just based on these valuation metrics. Okay, and that's a big part of it is to do with this loose monetary policy. Actually, two things. One is very low interest rates and the printing of money, the creation of money. So these two have acted together to really bring up the set price. So what happened is, if inflation were to creep up, which it has, and the Fed is insisting it's transitory. Of course, they will have to insist it's transitory, right? They can't say inflation is going to be long term. They will crash the market themselves. Okay. Well, the truth is nobody really knows. Is it going to be transitory? Is it going to be longer term? Well, sometimes inflation does take a life of its own. So that's something I think worth to look at. So I think, so if you look at it, the 10 years US 10 years treasuries, which is kind of an interest rate where the whole world kind of uses to price their assets. I'm not sure whether at Aberdeen is it also a key thing you look at. I guess so. So that rate has peaked in 31st of March this year at 1.74%, and ever since it has came down. Okay, what is the significance of this date, 31st of March 2021? Okay, it coincides with another date. Is it the reason? I'm not sure, but I guess there's a part to play. Okay, on the 31st of March, before that, because the Federal Reserve wanted the bank to be their kind of allies, to be able to spray the whole system with liquidity. And hence they allowed the bank, they can kind of temporarily waive certain capital requirement of the bank. And on 31st of March, they stopped that exemption. And this bank with plenty of money, because the Fed printed plenty of money, has got too much money. And too much money is a problem for the bank. When a bank holds cash, right, it's a liability to them, because on the other side, it's a liability to you, let's say as a depositor. And hence, they start to have to keep the reserve ratio, and they don't want to take in more deposits because they're up to the brim already. You can't take in more deposits. And hence, this money that the bank can't take in is flowing into the markets, excess liquidity. At the same time, the Treasury, because Treasury is the one that's borrowing money, so they also borrow way in excess. Maybe they're a bit kiasu. So they borrow way in excess to what they need. So they have 1.6 trillion in their savings account at the end of last year, which by August they need to pare down to 500 billion because of the debt ceiling. So they have been paring down, and at the same time, the excess liquidity has gone into the system. And all this money, I guess part of it would have escaped to actually buy treasuries. Okay, so I think it both coincided on the 31st of March. So I think if you can look at one chart, which is called the reverse repo chart, it's gone through the roof because of all this excess liquidity. So I think this is a temporary thing. It's not going to last forever. So the question is, after this period, will then the 10 years treasury show its true self? Which means, it's by right, it's supposed to creep up. But because of this plentiful liquidity, it has kind of suppressed it. It's still a guess. Okay. So I think longer term, I'm kind of apprehensive of inflation. I'm not saying to really, make a 180-degree change to your portfolio. Yeah, because there's a fear of that. But I think we need to be precautionary. Because outside of this, what I just shared, a longer term, there's two actions at play. Yeah. One, we've already seen Joe Biden. So Joe Biden already had a 1.9 trillion fiscal stimulus that's passed very shortly after he became the president. Recently, he got an infrastructure stimulus passed. That's about 1 trillion US dollars. And his plan is proposing a 6 trillion budget plan for 2022. Okay, so all these are big money. And where's the money going to come from? Yeah, borrowings. The US don't have money. Okay, so they need to be borrowing, which means they need to issue a lot of debts. And if that coincides with the Fed reducing their treasury purchase, yeah, then I think supply and demand, yeah, we're going to see higher treasury yields. Okay, at the moment, I don't think it's going to go through the roof, but I think we need to be precautionary. Yeah. And one thing is, there's this saying by this very renowned economist, it's called Milton Friedman. He said, there's nothing more permanent than a temporary government program. So most temporary government programs become permanent, like printing of money. It was meant to be a temporary program to stop short-term problems. And once they get used to playing with it, it becomes bigger and bigger. So now what is the government playing with for this COVID? Yeah, so now they have this temporary program of giving out stimulus checks to people. And I make a guess, it may be hard to stop. Once people are happy collecting stimulus check, suddenly going to tell them, I'm not going to give you money anymore. Yeah, people are going to be unhappy. And the president is going to be afraid of his own votes, right? So I think there's a likelihood that this stimulus check in some form or another may persist even well after COVID is over. Yeah, and this means people got more money to spend, and companies need to jack up their wages to attract people to work. Yeah, so I think that is the inflationary threat is really there. I don't think it's really as sure as what the Fed says is transitory. Yeah. My own guess is I don't think it's going to go through the roof like the 1970s, but I think it might be more heightened, more prolonged than what most people think. Yeah. So that is my concern about inflation. Yeah. Because if it doesn't happen, then good. Continue to have plenty of money. It's going to spur your stock price. So you're going to be very happy. Yeah. But you just need to be precautionary. If that happens, then the stocks will go the other direction.
If you'd like to be listening regularly to the Grey Rhino YouTube to gain more financial knowledge and also investment wisdom, do subscribe below to the Grey Rhino YouTube channel and remember to turn on your notification.